Hey, I'm Steve Lamont. Welcome back to another episode. We made it to 4. 1, 2, 3, 4. We here. So let's dive in. As we go in this channel, I want to start really touching on some of the things that I'm learning in the class. I think we just had to get some housekeeping and expectation management underway before we could really dive into it. Today, when I was studying, right? So we're studying for our insurance exam test, and we touched on the policies. So there's a couple of special policies. Like I was telling Andre, my engineer, I really like the specialty policies because to me, that just gives us a little bit of room to get creative, right? And that's what we want to do. One of them, though, I found it very interesting. One of the specialty types of insurance policies, it's the credit life insurance. So what I learned today is that you can get life insurance on people who owe you money. So if you are what's considered a debtor, someone who is in the debt of a person or an entity, the person who or individual entity who actually gave you that credit can go ahead and put an insurance policy on your life. Now, my first thought was that's a little risky because what if they say they're not going to pay you, but you got this policy over their life? That's a little questionable, to say the least. But nevertheless, it's done. And actually, some creditors can require you to have life insurance in order to give you a loan. Now, I would imagine that this is left for huge sums. So if you're an individual, loaning out $100, $200, $300 million, well, maybe it makes sense at that point to go ahead and put a little life insurance on that debtor. But for just normal credit card, can you imagine, right? Just imagine you go get a credit card, you got a limit of $15,000, and they say, yeah, we're going to need a life insurance policy on that, buddy. So if you decide to get a little frisky and die on us, we're going to go ahead and collect, which actually isn't too bad of an idea because what we really want to do is break the cycle of leaving the next generation with debt. So if you have a life insurance policy if you have credit or debt that's backed by a life insurance policy, when that day comes and you pass away, if you do have that outstanding balance, it's not going to be left to your kids. It'll be handled by the life insurance policy. So now that I think about it and kind of talked through it, that doesn't seem like a bad idea. It seems like you're forward thinking. This is for the individual who doesn't want to leave a lot of debt, right, to their kids. Look, when I'm gone, here's the cash. Go ahead and pay it out. Credit life insurance is usually written as decreasing term. We talked about decreasing term a couple days ago. So what is decreasing term? It's basically a term policy which a term policy is a level, meaning the premiums don't go up, they stay level, and the face value stays the same, right? So it's a term policy, but in this case, a decreasing term, the face value or the death benefit decreases over time because the concept here is as you pay down your debt balance, then you don't need as much money to pay it off. So the policy doesn't need to be as large. So that's an aspect of it. Debtors can require life insurance, but cannot require a specific insurer. Now that's something I don't understand why, but I guess probably because when you have an insurance policy on someone's life or you have a loan backed by somebody's life, you got to be careful on how that's administered. So maybe there's a reason why you can't require a specific insurer. Let's try to walk through this. Let's steelman this, right? So I just lent out $100 million to Andre, right? I require Andre to get some life insurance for, let's just say, $100 million. I don't know. Let's just say that out there. So I'm whole if something happens to him. So that's where it starts off because the balance of his debt is $100 million when we start. But, 5 years in, it goes down because he's going to pay this debt off over the course of, say, 15 years. It's a business loan, right? And Andre's a very successful businessman. And he has farms from here to Abu Dhabi. Man, he grows anything from cotton to corn. So he's good. Give him 15 years. The $100 million's paid down because he's one of the huge suppliers. He's in every grocery store that you can imagine, right? Andre's dairy products and Andre's corn and so forth, right? So anyways, kind of went on a little tangent there. You get the insurance policy because you're the debtor or you're the creditor, and you want to make sure that if something happens to your prized asset here, Andre, that you get your money back. Now, why wouldn't I be able to require him to go to the homies over here, ABC Insurance Company? Why wouldn't that be a good idea? Well, maybe because, I don't know. I mean, I guess I can throw it's pretty dark. When we're talking about this, the reasons why you wouldn't want it to be pretty dark. Maybe ABC Insurance Company doesn't have the same morals or integrity that you do, and But then if you're requiring them to go there, then I guess you guys are all in the same boat. So I can't really put that one together. So anyways, that stood out to me was credit card companies and banks can require life insurance on anyone who's borrowing money from them. In the case that they die, they get whole. I think that's appropriate for people creating generational wealth because you don't want to leave credit or debt behind for your loved ones. If you have your estate set up properly, when you pass, not only should your children get a lump sum from the death benefit and any of the unused cash value if you're doing a whole life policy, but any debt that you have should also get paid out by another policy that you have. So we want to stack these policies. You want to have policies that deal with your beneficiaries, get loaded up when you're gone. You want to make sure that any debt you have gets paid off when you're gone. You want to make sure that I guess that falls under property, right? Property gets paid off, the house, the farm, the business, right? You're again, we use Andre as an example because he's a renowned businessman and he has business partners, right? When he passes away, you want to make sure that there's a buy-sell agreement, and within that buy-sell agreement, there's an insurance policy so that your business partners aren't left scrambling to find the money to buy your share, your position in the company, but the insurance that you leave, they're able to take it out and go ahead and handle that. So let's keep this video short today. I wanted to just drop a little more knowledge and some value of some of the things that I learned today. We just really touched quickly on the concept of insurance or credit life insurance. Another cool one that we might touch on a little later on was group underwriting requirements. How fascinating is that? Maybe I can make it fascinating. Group underwriting requirements. So we'll try that another day. Is there anything else I want to touch on before we get you up out of here? Financial strength of the group. So this is just the eligibility requirements for group insurance. Man, my nose is itching. Oh, we're done. I'm Steve Lamont Greer. Thanks for tapping in with me. Catch you on the next one. Peace.